Hi, everybody. Welcome to another webinar of our series. Apologies for the delay. I think I have everything running up correctly. Hopefully, you guys can hear me speak loud and clear. You can hopefully see the first slide of the presentation, and whether you can see me or not, that's irrelevant, but if you do, that's an additional plus. So guys, please let me know in the chat whether you can whether you actually confirm that you can actually hear me loud and clear. Please give me a thumbs up in the chat. If not, I'm gonna have to fix that, and then we're gonna begin. Okay, I see people joining. That's good. Okay. So yeah, welcome guys to another episode of our series. Today we're gonna do what we call a scenario construction. So this is my interpretation of how to conceptualize and create, in a sense, a plan and develop it, but also analyze your potential plays. And at the end of the day, start choosing which instruments you would like to trade upon. So you need to go through a specific checklist. At least that's from my point of view. If you find this helpful, please adopt it as you like. But this is, again, for educational purposes only. I'm merely conveying my point of view. If you don't like it, fair enough. If you do like some parts of it, you can implement them to your own trading strategy. If you don't like anything, fair enough. Okay, so I'm gonna purely introduce a way of thinking, a way of going at trading. Okay, so this is a rationale, this is a thinking process, this is how I personally approach this. Again, hopefully you're going to find it interesting and insightful. So we're nearing the end of our webinar session. So after this, we're going to do a few live trading sessions, and they're going to be somewhat connected to what we're going to discuss today, but also it's going to incorporate all the things we've learned so far in regards to fundamental and technical analysis. More specifically, we're going to use a lot more technical indicators and assess what kind of information they convey. And at the end of the day, put them all together, scroll through the signs that these indicators are giving us. And finally, at least hopefully, if the market allows us to, or if there aren't enough, or at that point in time, decent enough opportunities, we're going to go ahead and trade together. Okay. For the time being, we're going to do the scenario construction, as I like to call it, the base case scenario. Okay. So if it's not clear what we're going to do today, please bear with me. So this is a risk warning and a disclaimer. I'm not going to go over them. At the end of the day, what is for information is conveyed throughout this page is that this information is for educational purposes only. There's no investment advice or investment recommendation contained herein. And at the end of the day, this redistribution of the material is strictly prohibited. So enough. Let's go ahead and start today's webinar since we are a little bit late. Okay, so we're going to do a rationale overview. As I said, this is a thinking process, okay, of how you can go at when it comes to trading. So the idea here is to effectively come up with an actionable trading plan. So if you don't have a plan, please go ahead and make a plan for yourself. If it's rough and crude, if it's not that detailed, fair enough, but at least have a plan rather than just blindly going opening up a chart and just trading it. Please do your homework, please study. Again, this is in your own best interest. Okay, the more information you have and the more information you take in and you do your assessment, you do your analysis, the better odds you have at trading. And at the end of the day, trading is a game of odds, of probabilities. So why not amass the highest percentage of probability in your favor before trading rather than just clicking buttons randomly. Okay, so again, the idea here is to effectively come up with an actionable trading plan of an instrument of your choice. You can do this on pretty much any instrument you would like. Analyze its direction, spot possible areas where price action may stall or break out from, not front, from. So this is what we call areas of friction. Okay, you're going to discuss this later on. Assess the current strength of the trend and momentum as well, if there is any. Stay vigilant and aware about possible fundamental factors that may impede or distort your kind of assessment, or if in that case, the favorable case, if it actually helps your assessment. And finally, come to a conclusion where a sufficiently good entry point may be, as well as drawing a potential line or having a target of where to exit your position as as soon as you have entered it. So having, in a sense, a target is also supremely helpful rather than just going long on a position or going short in a position and just keeping it open for whatever reason. Yes, you may make money, but at the end of the day, price action tends to reverse towards the mean, and most likely you're going to leave a lot of profits onto the table. So why not have an actionable, a valid, a decent enough exit point, take the money, and do the whole process once again from the beginning. Okay, so it's this kind of framework is, yes, it's helpful for long-term trades, but it's more calibrated towards short to medium kind of trend or short to medium kind of trading strategies. Okay, I'm just going to make it clear from the beginning. So a thing to remember is that there is no such thing as a quote unquote perfect trade. I'm pretty sure you know this already. So as traders, we must come in terms of finding the most appropriate trade at that point in time that has a highest probability of becoming a reality or coming into fruition at this specific point in time. Okay, so there is no perfect trade. There's none perfect trades. Okay, we make the best of what we have in front of us. Okay, we eat what we have in our plates. Okay, the point is to spot these opportunities as quickly or as effectively as possible, and then hopefully learn how to capitalize upon that and make the most out of them. Okay, these comments that I'm making right now may seem generalistic or generic in nature, but if you do this long enough, you're gonna understand what I mean. So trading is a game of probabilities. We mentioned this many times over the past I don't know, X amount of webinars. We've been talking about this all the time. So what we need to do is assess as many quantifiable parameters as possible, take all the information available that we have in front of us, or at least the ones we can tolerate, okay? Take them into consideration, analyze them, make an actionable strategy, and then deploy that, okay? Go ahead and take action, not just merely analyzing stuff, okay? So this is, again, a generic rationale of what we are going to attempt doing today, okay? And this is going to be helpful because in order to digest this kind of thinking process, we're going to ask ourselves in this kind of slide a lot of questions that are going to determine, or at least they're going to light a few light bulbs in our heads to just keep in mind what kind of information is relevant, what kind of information shall we be placing a lot more attention to, what kind of things we are hopefully looking over or looking into in order to come to that conclusion of what to buy or sell in this kind of case, how long I should be keeping it, and what are my targets. Okay, is this an actionable, efficient, effective trade we can take right now and make the most out of it or not? Okay, so this is the thinking process we're going to introduce today. So some questions that need to be addressed in order to grasp this kind of scenario construction are as follows. Okay, so first we need to identify where the market or the instrument is headed at. This is basic trend identification. Okay, so we've noted this many times in the past. Trend is your friend, especially, and then we're talking about it from a point of view of someone that starts trading right now, knows pretty much nothing. Okay, or it's an intermediate trader that got a grasp of things but is looking forward to adding more information and knowledge in his memory bank, if you would like. Okay, so these are the quote unquote suggested ways of doing things. So trade with the trend, because as they say, as a euphemism, trend is your friend. So trade with the trend, not against it. There is a time and place to go against the trend, trust me, and you can become profitable by doing that, but it's not ideal for someone that starts trading right now. The first thing you need to understand when you start trading is identifying the trend and going with it is the safest way to stay in the game long enough, not to become profitable, to stay long enough in the game in order for you to become then profitable. Okay, so it's you can conceptualize trading with the trend as a risk mitigation kind of technique as well. Okay, there's another dimension to it, but still, so something we need to understand and start conceptualizing these things is where the market or the instrument is headed at. Okay, find the direction it's trading at. Is he making higher highs and higher lows, or lower highs and lower lows? Is he moving in an uptrend or a downtrend, or is he in a sideways kind of fashion? Okay, we need to establish that as quickly as possible, and then we build from there onwards. Okay, so trend identification is one of the most crucial things you can do at that point in time when you start analyzing or looking at a chart or an instrument of your choice in a little bit more depth. Okay, so another question to ask yourself is, are there any points on that specific instrument's price action that you see a lot of support and resistance taking place, or in other words, points of friction? Okay, I'm pretty sure all of you guys know what support and resistance levels are. We are talking about areas where the price action is failing to exceed, or failing to break above from, or failing to cross. Okay, because mainly there is a lot of sellers there if we're talking about an instrument that is moving to the upside. Okay, and on the opposite case is support is an area where we continually see buyers getting into the picture and averting the price action from falling onto a lower level. Okay, so support and resistance levels, key concepts in technical analysis. We've covered them in the past in extensive fashion. If you're not familiar with these kind of terms, please go ahead and you watch these kind of webinars on YouTube as well, refresh your memory, and digest these things as soon as possible, because they're super basic, but they're super helpful at the end of the day. And if you add a lot of these super simplistic and basic stuff to your analysis from the get-go, you're gonna see where things are diverging from your scenario, or they are having confluence. That means, yes, all the other things are aligning together, so I have much higher probabilities of placing a quote-unquote correct trade or an appropriate trade at that point in time. Or some things are giving me different indications, different signals, which are distorting this kind of point of view, and therefore I'm going to be placing a lot more attention, a little bit less faith in my probabilistic kind of assimilation game. Okay, so another question to ask yourself, besides where the market is headed at and where you have possible areas of friction, is who is driving the instrument's price? Okay, super simplistic. Is it the bulls or the bears, or neither? Okay, again, is related with who is driving the price action to higher ground. Possibly at the end of the day, it's going to be bulls, or the supreme strength of the bulls and the absence of the bears if the price action is moving to the high ground as with a fast pace. Opposite also can be true. So identifying who is in control is superbly important as well. So not only on the short to kind of medium kind of trend, but also on the super short kind of time frame as well. Yes, the bulls are clearly driving the price action of this specific instrument towards the upside, because we're seeing higher highs and higher lows. But on a shorter time frame, you see that the bears are actually getting momentum. The bears are actually entering the picture, and they are not allowing the price action to head to high ground. Yes, we're going to pay attention to that, both on 2-time horizons, okay, from a medium point of term, but also from a short-term point of view, because we need to spot early shifts in trends, okay, and we can act upon them accordingly if enough data points to our assessment being correct or not. Okay, you will see what I mean soon. Okay, so how and another way of gauging who is in control, the bulls or the bears, is going to be by the usage of a lovely technical indicator called ADX. We've done this, we covered this material on the last webinar, the webinar before that, if I'm not mistaken. Positive DI and negative DI, positive directional index and negative directional index, gauge that kind of strength of who is in control, the bulls or the bears. RSI is another indirect measure of who is in control. Again, another technical indicator we covered in the past, and you're going to see them in practice. But yeah, there are available tools at your disposal, technical indicators that can give you this information we are actually looking for. The question we have asked right now, who is driving the instrument's price, the bulls, the bears, or neither? These can be given to you by technical indicators. And if you study them closely enough and longly enough, you're going to understand what information they convey, and you're going to have a much more clearer view of answering that kind of question. Okay, you're going to have a definitive, quote unquote definitive. There's no definitive, there's no 100% sureness in this kind of game that we call trading, but still, you understand what I mean. Okay, how strong the current trend is another question that we need to ask ourselves. Is it at the early stages of developing? Is it at the accumulation phase, or is it at the end of, for example, when the price action has surged by a significant amount and you can clearly see that that specific instrument is overextended? And are we looking at a price action of an instrument at the end of the cycle? Are we looking at the price action of an instrument at the start of a cycle or in the middle of the accumulation phase? Okay, so we need to identify, and there is a lot of ways of doing that. So, for example, Elliott waves, if you study close them enough, you're going to see that they give you a basic template of how price action is headed at, and it's going to make it much easier for you to spot on which kind of cycle of a trend we are actually at. And if you understand and if you spot that correctly, you're going to have a different way of approaching the situation. Okay, so at the time being, we are merely observing price action. We need to understand on a granular level what is going on. Okay, this is what we attempt to do here. Clearly look at the chart and objectively come up with clear definition or clear instructions of where the price action is headed at in order to make it predictable. And if it's predictable in our heads, from there onwards, we can take actionable steps of placing trades and hopefully capitalizing upon that and making money. Okay, because this is the target at the end of the day. So we covered 4 basic questions so far. Let's go to the 5th one. Are there any signs that foretell a shift in the current trend? This is probably going to be given to you. This is going to be probably answered by not sporting, but studying closely oscillators, okay? Stuff, technical indicators you add to your chart, which are gauging this specific thing. For example, you can look for divergences in the RSI indicator, okay? For example, the price action is making higher highs and higher lows, okay, moving in an uptrend, whereas RSI, the oscillator that gauges momentum and many other things, so the strength of the bulls and the bears, is not making higher highs and higher lows, okay? That means we have a divergence between these two, the price action and the technical indicator. So this is a flag for us to look closely of whether this price action is going to continue moving higher, and if so, possibly if the RSI is not making higher highs and higher lows, is not matching, possibly the upside from here onwards is not going to be as high as in the, let's just say, prior 1, 2, 3, 4 days. And we are reaching the end of this kind of stage, okay? You can spot this with the usage of many technical indicators as well besides RSI, but RSI is my preferred choice of gauging this kind of thing, okay? So looking at the end of the day for divergences, when we ask for this question, are there any signs that foretell a shift in the current trend, okay? RSI may be one answer, or moving average, convergence and divergence, MACD can also be another insightful kind of technical indicator that's going to give you this point of view, this confirmation. You know what? If there is none, that means the trend is going to continue, or is continue, most likely is going to continue going that direction, not uninterrupted, but at the same pace as it used to in the past. Okay, so small differences, but still. So another question is, are there any candlestick formations that can provide us with additional clues? Okay, so besides technical indicators, we look at charting analysis more specifically. So under the technical analysis bracket, we're going to go into the charting analysis kind of bracket, which we are studying closely candlesticks, individual candlesticks, but also bundled candlesticks together that are forming kind of what we call chart patterns. And chart patterns, from my point of view, are important because at the end of the day, I can extrapolate with this kind of observation that the rationale is when you have a lot of people looking at the same kind of chart pattern, most likely or most usually, they tend to create the follow-up moves that come after the formation of the pattern is made. So that means, in other words, what I'm trying to say is a psychological factor, what we call a self-fulfilling prophecy. So if, for example, you see price action rising and making what we call head and shoulders formation, hopefully you're familiar with this kind of chart pattern. For example, the first shoulder, okay, it's the first peak. The second peak is the head, which is higher The peak is higher than the left shoulder, but then the third shoulder, the third attempt to break into fresh territory does not happen, and it's below the head, what we call as the head and shoulders. Price action might fall from the right shoulder much faster because people or traders are expecting for that price formation to happen, and they're gonna force it to happen because that's what they expect to happen. Understand what I'm saying? They are acting with this kind of what we call a psychological factor, the self-fulfilling prophecy. They are expecting to see head and shoulders, and maybe they do realize it, or maybe they don't realize it, but at the end of the day, most likely they tend to force that pattern to be completed, okay, because they are actually expecting that to happen. And if you have a lot of people doing the same thing, okay, most likely you're going to see this formation of patterns becoming much more clearly, and the drops is going to be much more sharper, etc., etc., etc. So knowing far ahead, way ahead, or doing your homework and understanding and having a conceptual map of chart patterns in your own head. When you go at trading and when you look at charts, you're going to start spotting these kind of trends. And this is going to be, these patterns, excuse me, this is going to be super beneficial for you because you're going to have in the back of your mind, you know what? I see a head and shoulders formation happening right now, or I see a cup and handle formation possibly coming into fruition. Okay, what is how am I going to approach this? Okay. You wait for that to, in a sense, give you a corrective sign or a definitive sign, and then you go ahead and capitalize upon that. So knowing these kind of things are super important for you. Are all the available technical indicators deployed, communicating the same message? This is what we call a convergence or a confluence. Are they telling you the exact same thing? Are they aligning together? Are they telling you, you know what, price action is going to head to high ground, or they are in contrast with each other? Okay. Again, super helpful things to consider. So, because you're not going to be going blindly trading. So, what are they telling me under different time frames? Are they conveying the same information, or again, are they diverging? Okay, so you're gonna do the time frame analysis as well on this kind of webinar. Okay, so beyond the technical analysis field, because what we have talked about so far is purely on technical, we're gonna have to consider about other macroeconomic factors that are affecting the instrument's price. We're talking about fundamental analysis now. Are we having any new economic news releases throughout the day that are expected to distort the price action or influence the price action? Okay, so that is why it's important to have a calendar up to date and looking at what stuff, what releases are going to be going through the day, and learning about fundamental analysis on a deeper level is going to give you that kind of insight to expect things happening. And once they start happening, you can capitalize upon them. For example, if we have an above the expectations NFP print, it's going to be next Friday. Hopefully, we're going to do a live trading session around that time. How is that going to affect the price of gold, or price of the dollar, or the price of stock markets? Okay, or an index more specifically. Understanding what are the fundamental drivers that affect these kind of things beforehand, and having an eye, or keeping a tab open of what to expect throughout the day is also super beneficial, because you're gonna eliminate the chances of having something unsuspecting happening to you. Okay, so keeping an eye with economic news releases, it's super important, and the importance of calendar is, we cannot stress this more enough. Okay, so are fundamental and technical signals in agreement? Are we seeing the same thing? Is the data, the macroeconomic data, supporting our point of view with the technicals? Okay, is for example, Eurozone going to outperform in the fourth quarter of 2024? That means the euro is going to start rising against its counterparts, okay? And the technical indications are giving me the same thing or not, okay? So being aware of how economic news releases impact that kind of instrument, for example, euro dollar in this kind of case, and technical analysis does. With our analysis, we come to the conclusion that the euro is going to be outperforming the dollar in the next quarter. Gives us enough information for us to, or much more confidence in our analysis that the euro is going to possibly head north. And if we go long a contract on this, we're going to make money. Okay, so that's one way of conceptualizing. Another way of conceptualizing this. Okay, so beyond technical and fundamental reasons, we're going to also discuss what is your profit expectation on this particular trade. Okay, so coming up with a scenario, finding your signals that are in your favor, or at least they are in accordance with what you expected. Okay, they're selling you the same thing. The signals are, in a sense, aligning with your assessment, and we are ready to trade. You need to come up with a plan of how much you're willing to risk and how much you're willing to lose in this kind of trade. Okay, because at the end of the day, we talked about this. This is a game of probabilities. Yes, the odds are in your favor, but things can go wrong. If they go wrong, if they go wrong, excuse me, how much am I willing to lose? Okay, these are, or how much am I willing to gain from out of this? These are valid questions you need to ask yourself before placing a trade. Okay, so having a risk kind of assessment before you go ahead and do that, it's super important, because it's going to force you to pick a better entry point, but also calibrate your exit point accordingly if you have this kind of risk reward kind of mentality beforehand, before placing a trade. Okay, before executing the trade, you need to think of this beforehand. Okay, so what is your profit expectation? What is your risk tolerance in this particular trade? Are you willing to lose 30% in order to make 40? Okay, in my universe, in my reality, from my point of view, this is not sustainable. I like to go with at least a 2.5 or 2.5, 3 to 1 risk reward ratio. That means I'm willing to lose, for example, 10% in order to get 20 or 25 or 30%. Okay, or let's bring it down, for example, accustom that to the FX market. I'm willing to lose 1% in order to gain 2.5, and 3%. You get the idea. Yep. So the risk reward ratio is something I consider beforehand. Okay, and it's influencing my at what point in time I'm gonna be entering the position or not. I'm gonna be giving it a little bit more time to develop before I go into it, to make have much more convenience on my side, or am I gonna jump straight through? If I'm gonna just jump straight through into the trade, I'm not gonna have the perfect or the ideal risk reward ratio in my mind. Maybe I'm gonna have 2 to 1. Okay, so again, you adjust your behavior accordingly with the data you have in front of you. Okay, another question is, how much capital are you willing to allocate to this particular trade? For example, if you have a $10,000 account, let's just say $1,000 account. Okay, you made an analysis, you picked up your case, you made a scenario, you constructed your scenario. Okay, and you found an ideal play. You're willing to place a position upon this. How much are you willing to trade on this one? Are you going to go all in? Are you going to use 100% of your capital in order to see this kind of trade come through? Or are you going to have a specific and reasonable rule to your game? I'm going to be investing 20% of my capital, okay, of my equity at any particular trade, because I want to minimize the risk of me losing, okay, all my capital or an excessive amount of capital. The point is to have rules in place, money management techniques in place in order to allow you to stay in the game long enough, even if you are having success, or at a time where you're going to be feeling the heat from the market, or if at the time where you're going to be losing money, because let's face the reality, we are going to lose money in stock markets or in markets in general, in trading in general, because we're talking about one of the most unpredictable things you can attempt to predict. So you need to familiarize yourself with losses and at least accept the fact that you're going to be losing money in points in time. Okay. But at the end of the day, you are in charge of how much you're willing to lose, and how much you're willing to lose or how much you are actually going to lose is actually dependent upon you, whether you're going to be using stop losses and take profits. Okay, take profits is not relevant in this kind of scenario, in this kind of case we just outlined, but in this kind of case of our most importance are stop losses. So if you make your assessment, you say, you know, this price action is going to head to high ground, I'm going along, okay, I'm willing to lose 10% of this kind of trade, place the stop loss there at 10%, okay? Don't say, oh, you know what, when it goes to 10%, when the price action goes the other way and I'm going to be losing 10%, I'm going to close it manually. No, please. Go ahead and place a stop loss order. If that target closes out the position, fine, you've lost the position. Fair enough. You've lost 10%. Then you go on. You didn't lose everything. You didn't crash and burn. Okay. So you need to get familiar with the losses aspect of things. And the best way to get familiar with the losing aspect of things. Nobody likes losing, obviously, but everybody likes losing less than more, if you know what I mean. Okay. So stop losses are going to do the trick. The point is to stick by the game, stick by your rules, and let them get triggered and not move them lower and lower and lower. Okay. So stick to the game. If, for example, this trade you're expecting to make 30% and now you're willing to lose 10%, if it goes the other way, you lose 10%, done. Fair enough. Go on. Okay. Rather than just, oh, you know, the price action has fallen 10% and then I'm going to switch my stop loss to 15% and then to 20% and then 30, and then you crash and you burn. Please don't do that. Get familiar with losses. Nobody likes them, but they are an essential aspect of trading. Okay. The sooner you get familiarized with losses, the better off you will be, because you're going to be having that reaction, the negative reaction towards it. Okay, I don't want to be losing. I'm going to be focused on my game. I'm going to be making my analysis much more accurately, much more specific, much more calibrated to the situation, and then you're going to have much better success. Okay, then what you need to do is have enough practice before crashing your account. That's what I'm trying to say at the end of the day. Okay, so small losses are acceptable rather than one big loss that's going to wipe out your account. Okay, so please use stop loss orders. Is the safest way for you to guarantee the minimum amount of damages. Okay. So have you deployed the necessary risk mitigation techniques to protect yourself from unwarranted adverse movements? Stop losses are the answer to this. Did you use all the available tools at your disposal? There's no need to use everything you know of, okay? If you have, let's just say 15, 20, or 30 technical indicators in your arsenal that you know them really well, there's no need for you to use all of them. You need to use a few of them. Basically, you need to use enough so they don't confuse you. Let's just put it like that. So for me, it's somewhere around between 4 to 7. I cannot handle more than 7 indicators at the same time. Maybe 7 is too much at some points in time. Other people like to use more than that. Fair enough. If you can handle that kind of overstimulating kind of environment, fair enough. The 7 for me is the maximum. Okay. I like to use somewhere around 4 to 5, 4 to 6, maybe 3 to 5, let's just say on average, in order to gauge what I want, because you need to use different indicators that they are not the same, but they are having some sort of overlap that you can rely upon. Okay. You're going to see them in practice on the live trading session. Okay. So did you use all the available tools at your disposal? Okay. Did you do your homework? This is one of the most important ones. Okay. Have you studied that instrument enough? Or are you just looking at just merely going over it and just saying, you know what? Okay, I've had enough. I don't want to look at this anymore. I'm just going to go along because that's what I feel. No. Please study and do your homework. thoroughly because it's going to be on your own benefit. Okay. It's better to spend 2, 3, 4 hours looking at something or a case of things or various examples of charts before trading rather than just spending 5, 10 minutes and just going straight into, especially if you're on an early stage, it's much more beneficial for you to have that let's just say skin in the game by looking at things and analyzing things beforehand and then actually trading rather than just straight go to the point and execute. Okay. So this is what we are attempting to convey with this kind of webinar, this kind of rationale, this kind of thinking, this going through all these steps that are going to be helpful for you to go ahead and execute at the end of the day. But you need to do pretty much all of them or many, 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 many times in order for them to become automatic. I'm not even thinking about this consciously. I'm doing it unconsciously because I've done it consciously more many, 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 many times in the past. So, I good with. Please explain number 6 and an example of number 16. Which one is 6? 1, 2, 3, 4, 5, 6. Are there any candlestick formations? Is this the one you are asking about? Are there any candlestick formations that can provide us with additional clues? Let me know in the chat. Godwin, this is 1, 2, 3, 4, 5, 6. Yeah, this is a 6th point. Okay. And 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. Okay. Yep. Okay. So candlestick formations. If that is a question. If you're not familiar with this kind of term, we have a webinar on candlesticks. You can find it on YouTube. But in the gist of things is that we study individual candlesticks because they convey this information, what has happened throughout the day. Okay, starting at those weeks. And if you have a lot of candlesticks bundled up together, 1, 2, 3, 4, 5 candlesticks, and they create a sort of pattern, we in a sense look for those patterns because they have underlying kind of meanings. Okay. So for example, if you look at 3 white soldiers kind of formation or 3 black crows or a morning star kind of formation or an evening star kind of chart pattern, these are signals that technical analysts or traders look for, okay, because they have underlying meaning and for some reason they all act in the same way, which are conveying some sort of information. For example, some patterns are signals, early signals that the current trend is going to reverse. Okay. Other chart patterns are indications that the pattern is gonna continue where it's from. So continuation patterns or reversal patterns, there are a lot of them. Unfortunately, I don't have enough time to go ahead and show you examples in this kind of webinar or explain them even further. Please go ahead and watch this on the YouTube. We have this kind of webinar onto the series. You can study or you can watch this as many times as you want. Okay. In order to conceptualize this even better. Okay. So again, at the end of the day, we are actively looking for these patterns. We are actively observing to see whether these kind of patterns are appearing or have appeared on price action in order for us to get these better clues to make the probabilities of making money much more easier for us. Okay. So 16 is do you use all the available tools at your disposal? Available tools are everything in a sense that I have discussed, this kind of rationale, but also technical indicators that we're gonna apply onto our charts to see what information they convey, but also some basic charting lines, for example, drawing trend lines and support resistance levels. These are what we call tools that you can use when it comes to trading. You can use, for example, the ADX as a technical indicator. You can use RSI, you can use MACD, you can use Fibonacci retracements if the price action is retracing, or Fibonacci extensions, or you can use parabolic saw, or you can use Ichimoku clouds. There are a lot of them. The point is to come up with four, five, six technical indicators that for some reason you feel confident enough of learning, placing a lot of attention to them, learning them thoroughly and in depth, and using them as tools. This is what we mean by tools. Those technical indicators are freely available. Computerized algorithms by the program, by the software that conveys some sort of information. If you're not sure what kind of information they convey, we have, again, webinars that go through each and every one of these that I find personally interesting and insightful, and those webinars can, in a sense, present to you how you can decipher them and what kind of information they convey. Okay, so let's finish up with this kind of slide. Did you do your homework? Okay, so did you go over your trading journal? So I've stressed this in the past as well. It's super helpful when you start trading to have a trading journal. For example, if you place a trade and you made money out of it, okay, perfect. Screenshot, okay, or save that image and do a small commentary. Write something on top of that price action on that chart. For example, yes, I've entered at this level, I've exited at this level. I've practiced my my scenario construction steps 1, 2, 3, 4, 5, 6, 7, 10, whatever that is. I've done this and this and this, and the trade went as I wanted. I made money. Perfect. Create a journal, create let's just say a library of examples that you have done so far when it comes to your trading. Okay, everything you have traded, every trade you made, at least dedicate 5-10 minutes to screenshot it and just write something on top of it in order for you to go back into the future, look back at what you have done so far, and hopefully spot mistakes, but also spot what you're doing right and keep doing that. Okay, so this is for you reevaluation process, which is gonna harness, is gonna sharpen your tools even better and your understanding and how you see things. If you have actionable data of your actions from the past and you study them throughout time, you're gonna get a lot more nicer insights, not only about the market but also about yourself and how you act, which is super important. Do you get panicky when you see the price action going the opposite way as soon as you open the trade? Okay, fair enough. You hit your stop loss. Perfect. Screenshot it. I've lost 7% on this kind of trade because I didn't see the economic news release that was about to come, about to be released at the time that I started trading. Okay, and this kind of created a volatility kind of spike that crushed my position. Okay, write that down. You're going to say, next time I'm going to be paying attention to the calendar. Okay. I've had this problem many times in the past. I've now learned to look at the calendar and keep an eye on these kind of economic news releases that are coming up, and they are distorting the price action and they are messing up with my plans. Okay. So that's another example. Or you place a trade, you went long on a specific instrument, is moving on a sideways fashion because there is no enough momentum. Okay. Close the position with minimal losses or minimal gains and just write down, I'm not going to go into this position again because I didn't see enough volume or enough interest or enough momentum or enough volatility for the price action to move. And I was just holding the position throughout a period of time without the price action doing anything. Okay. So next time I'm going to look at that example. I'm going to say, oh, you know what? I'm going to be looking at volume and momentum before I place a trade, because I want it to go somewhere quickly, because I don't want to have a position open and get charged swaps for no good reason. Okay. So these are valuable examples that you need to have at your disposal, actionable past data about your trading actions in order for you to review periodically throughout time in order to understand who you are as a trader, what do you do wrong, what do you do right, but also how do you act in the market in trading. Okay, super helpful. This is for your own introspective kind of practices. Okay, so there are 4 core aspects. Finally, let's close this section by saying there are 4 core aspects of price action, what we call market structure. Okay, how is that instrument behaving in a sense, what is actually trending, what we call momentum, okay, volatility, but also relative strength. Okay, so these are the four core aspects of price action. The things that I like to look closely at, because yes, I have my correct assessment of where the market is headed at. I want to see how fast it can reach my target. I want to see how much distortions are they going to be there, and whether they're going to be mess up my plan, but also the relative strength of the move, which is going to give me an indication of, again, how strongly that move is going to get deployed, or how fast the price action is going to move towards to next. You can gauge these kind of things with technical indicators, but also many other tools. We don't have any much time to discuss, unfortunately. So we have 3 more slides to go. So again, some examples of tools at your disposal. So Godwin, this is your question about number 16. Did you use all the available tools at your disposal? This is some tools, not all. This list does not include everything. These are some tools that you can be using on a daily basis when it comes to your trading. Okay. So these tools are, for example, candlestick formations and patterns. Okay. Question number 6, again, from you, Goldwyn, which at the end of the day is a tool, okay, if you learn how to spot them, is a tool of identifying a trend. Okay, trend identification tool. It helps you do that. Okay, trend lines also do the same thing. You draw, in a sense, basic, super basic lines on higher throws of a price action or lower highs of a downtrend kind of moving instrument, in order for you to have a visual illustration that the market is moving to that direction, either upside or downside or sideways. They're not some sophisticated kind of tool. They are basic visual illustrations of where the market is headed at. Okay, this is for your own confirmations and your own easy to see kind of approach if you use them. Okay, so trend identification purposes, a tool is drawing trend lines. Okay, to identify and highlight points of friction, a tool you can use is horizontal support and resistance levels. You can also do with them with an angle, but let's just stick to the basics. If you see, for example, an area, if you want to, if you are into a position and you want to see where potential areas of stalling might take place into the future, the best thing you can do, or the easiest thing you can do, is highlight past points of friction. Okay, so in a sense, draw support and resistance levels. Okay, that's another available tool, super simple to use. So when it comes to gauging momentum and volatility and all those other lovely breadth kind of indicators or core aspects of price action, the tools that we have available for us are technical indicators, and we have listed a lot of them. And when it comes to assessing potential impact or future or forecasted kind of impact, we do fundamental analysis and news releases, not only about things that already happened in the past, but also how fundamental analysis or upcoming events can impact our assessment going forward. Okay, so because these things are scheduled ahead of time, you have forecasts as well. So that give you that kind of forecast from economists is actually giving you an inside kind of point of view of what to expect. Doesn't matter if it does matter whether it's above or below expectations at the time of the release. But beforehand, you at least have something to aim at. That's why we use fundamental news releases as a tool to assess potential impact. Okay, so for risk mitigation purposes, the tools that we have available at our disposal is what we call the take profit and stop loss orders. Super simple and super easy to do, to deploy onto your trading strategy, if you will, like. Super hard to abide by. Okay, so please practice with that. So when it comes to money management, a tool that you can use is what we call funds allocation. So again, thinking about how much money I'm going to put in this kind of trade. If I have, let's just say, $1,000 in this account, okay. For some reason, I have a high degree of confidence that this kind of trade is gonna be profitable. I'm willing to risk or to allocate 30% of my portfolio, of my equity, of my capital in this kind of trade, because I have higher chances of becoming a reality. Okay. Or you may have a rule that you will always, no matter what, use only 10% of your capital at any given trade at any given point in time. Okay. That's another rule, maybe a little bit more strict than the other, but still, it needs to be fitting or suiting your interests, your likes and dislikes. Okay, so this is a subjective kind of question you need to ask yourself. There's no correct percentage of fund allocation that is going to apply for everyone. No, some people behave in a much more riskier manner than others. Therefore, you're going to have a much different kind of approach and much different fund allocation to your own trading strategy. Okay, so finally, you can use other tools to gauge some sort of instrument correlations, which at the end of the day, they are assessing potential impact. For example, if you made your base case scenario and for some reason you came up to the conclusion that the dollar is going to probably strengthen within the next week or so because of X, Y, and Z reasons, okay? All the technicals are telling you that, okay? Fair enough. So therefore, you have a long bias on dollar. It's going to be unwise to have a long bias on gold as well, okay? Because they have an inherent negative correlation. So that means when the dollar is rising, most of the times gold is falling. Okay, so there's no logical reason for you to go long dollar but also long gold. In some cases, in isolated cases, you can actually see that the dollar rising but also the gold rising alongside with it. But from a generic point of view, that's not a positive correlation between these two instruments that we have chosen to give as an example, because they tend to move on the opposite direction. Okay, so doesn't make sense if you go long dollar to go long gold as well. It makes sense to go long dollar and short gold. Okay, but again, it depends on your risk appetite to do these kind of things. Okay, so I think we're gonna have to close the show shortly, guys. Let's finish with this kind of slide. So a simple example of a scenario construction rationale. So this is a super simple checklist that you can use on your trading journey as well. So let's start with the first kind of point. So review the current market conditions and the underlying analysis and your underlying analysis. Okay, you've done all these kind of things, and now you are looking at market conditions. So what are they telling me? Okay, so confirm that both your fundamental outlook and technical signals are in agreement. So you ask all these lovely questions, you go each and every one of those steps over it, you have an answer for it, okay, and then you test it. Okay, are my fundamental and technical indications the same? Are they in agreement? Are fundamental reasons going to yield some positive results into the euro, and the euro is going to rally? And also the technical indicators are telling me that, you know what, the euro is going to continue making higher highs and higher lows. Perfect. If you are in agreement, you have your first tick. Okay, so reviewing current conditions, current market conditions with your analysis, see whether they match or not. If they're not, go back to the drawing board, or calibrate your assessment accordingly. Okay, so evaluate at the end of the day why you have dismissed opposing information. Have I looked at something, at one key aspect of information, and because it does not fit with the narrative that I have, I chose to close my eyes and go ahead and trade it? Okay, sometimes we do that, but let's just say if you have a checklist of 10 things and you tick the 9 of them and one of them is not matching your assessment, that's acceptable. But if you have a checklist of 10 things and 6 of them are not matching your assessment, that's a problem, and you actually go ahead and trade. Okay, so making exceptions periodically is okay, but at the end of the day, we need to see a lot of confluence, a lot of convergence between what we have in front of us, okay? And not dismiss actionable information that may distort our plans, or closing our eyes and saying, you know what, never mind, that indicator is flawed and my assessment is correct, and then you place a trade and a position gets crushed, okay? So you need to evaluate opposing information as well, why you have dismissed opposing information, okay? Third point is identify key support and resistance levels to pinpoint optimal entry and exit points. Again, this is ultimately upon your risk reward tolerance, okay? So support and resistance levels alongside risk reward ratio is going to give you when to exit the point according to your likes and needs, when to enter the position and when to exit it, okay? Also, you need to specify the price level at which you plan to enter the trade. Price action, you may say at this point in time, yes, I have a long bias, but the price for some reason is not affordable enough for me or appropriate enough for me. I'm gonna wait for a small pullback to meet this target, and then I'm gonna go long. Okay, that's one way. That's another way of conceptualizing. Not because you just found an assessment and it says long, 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 you just jump straight to onto the chart and just placing long orders. No, I wait for the price action to pull a little bit back. Okay, get it at a better price and then execute. Okay, these are small adjustments that you do when you finish your analysis in your best case scenario and you need to deploy your strategy. At the end of the day, we need to have and establish a realistic take profit target. So ludicrous take profit targets never get met, okay, or no, they don't get reached. So therefore, you just see, for example, that you are 30%. You're making 30% profit or 20% profit, whatever that is. And because you didn't have a take profit and you were greedy, a price action did what it was supposed to do, go all over the place. And then, for example, come back down to 8%. So you lost, in a sense, 12% because you didn't have a take profit. And then you just scratch your head and say, why did I not close the position? Because you need to have these targets beforehand. You need to draw where the price action is you expect it to go at, and once you go at that point of level, you exit, okay, your position and make money and move forward, okay? So set a stop loss at a point where the trade no longer aligns with your initial analysis, indicating that your position is invalid. So if it goes the other way, okay, fair enough. Stop loss is going to do the job. It's going to close my position. I'm going to use the minimum amount of money that I'm going to lose the minimum amount of money that I have, and I'm going to go forward. The last 3 are determine how much you're willing to lose in a single day or a single session or a single trade. Super important to have that back of your mind from the beginning. Adjust your position size that your potential losses align with your predetermined risk tolerance and budget. Okay, another super important thing. Okay. And finally, enter the trade once the price reaches your entry level or set at the pending order at that point in time. Okay, pretty much a similar kind of note that we have up here. Specify the price level at which you plan to enter the trade. Okay, so we are running out of time, guys. This is the final kind of slide. So some words of wisdom to close this session. So low volatility is where trends are born, and high volatility is where they go to die. So the ethical kind of lesson after this is please attempt to spot trends as soon as they start to emerge, ride the wave and exit them when you have high volatility. Okay, so enter the market when it's low volatility and exit the market when it's high. Okay, much more easier said than done, but at least this is what we are aiming to go ahead and do. Okay, So what to expect in the next session? We're going to do a live trading session. It's going to be hopefully nice. We're going to have enough available plays at hand. Hopefully we're going to display what we have learned so far. And yeah, hopefully we're going to catch you on to the next webinar, okay, for doing a live trading session together for an instrument of your choice. Okay, so guys, we're going to have to cut this session short. Thanks for watching. If you do have questions, please send them through right now. If not, please send me an email. More than happy to answer them. But yeah, for the time being, let's just keep it nice and short. Thanks for watching and see you next week. Okay, take care. Bye-bye.